Ever feel like you need a PhD just to understand what's going on in the markets?
Well, you're not alone.
Today, we're going to try to decode some of those signals.
Yeah, we're diving deep into trading chart patterns.
This is the deep dive, by the way, where we break down complex topics, make them make sense. And we've got some really interesting material from forex.com US.
That's right. They've laid out 11 key chart patterns, the ones traders use to try to figure out where the market might be heading.
Exactly. Like, are we going up? Are we going down? Is it time to jump in or get out?
And the idea behind these patterns is that history, like in the markets, doesn't repeat itself exactly,
Right.
but it often rhymes.
It does.
So these patterns are kind of like recognizing those rhymes, seeing those familiar shapes in the price action.
So we can get a little sneak peek into the future?
Maybe just a glimpse, but hopefully enough to make some informed decisions.
So 11 patterns. That's quite a bit.
It is, but forex.com US breaks it down into 3 main categories.
Okay, that's helpful.
We've got continuation patterns.
Meaning things are probably going to keep going the way they are.
Right. Then there's reversal patterns, which, as you might guess, suggest a change in direction.
Okay, so things are about to switch up.
Exactly. And then we've got bilateral patterns. Those are the tricky ones
Why are they tricky?
because they could go either way. It's like the market saying, I haven't decided yet.
Like flipping a coin, huh?
In a way, yeah.
Yeah.
So our mission today is to equip you with the basic tools to spot these patterns on a chart.
Right, because charts can look pretty intimidating.
They can, but once you know what to look for, it's like having a roadmap to the market.
I like that analogy. A roadmap.
Yeah, you can start to see those landmarks, those signposts that can give you a better sense of where things might be headed.
And remember, we're not promising you'll become a master trader overnight.
Of course not.
This is about giving you a solid foundation, that basic understanding so you can follow along with conversations about trading and, feel a little more confident.
Exactly. It's about empowering you to make your own informed decisions.
So let's start with the building blocks, the most basic trend lines.
Okay, sure. Our source kicks things off with something called ascending and descending staircases.
Staircases. Sounds pretty simple.
It is, actually. Think of an ascending staircase as the market steadily climbing higher.
Okay.
You see higher highs, each peak surpasses the previous one, and higher lows.
So even when it dips, it's not dipping as low as it did before.
Exactly. That's generally a sign of an uptrend, a bull market, if you will.
Right. The bulls are in control.
And our source points out that those dips along the way, those higher lows, can actually be seen as buying opportunities.
Ah, the classic buy the dip strategy.
Exactly. You get to buy into that upward momentum, potentially at a slightly better price.
Got it. And I'm guessing the descending staircase is just the opposite.
You got it. Lower highs and lower lows, like the market's gradually sliding downhill.
So the bears are running the show in this case.
Right. And those little bounces upward, those mini rallies, could be seen as opportunities to sell.
If you're thinking the downtrend is going to continue.
Right. And now let's move beyond these basic trends and into those more specific chart formations.
Okay, sounds good.
Started with continuation patterns. Remember, those are the ones that suggest the current trend is likely to persist.
Right. Let's dive in.
A classic example is the ascending triangle.
Okay, ascending triangle. What does that look like?
Imagine a triangle with a flat top
Okay.
and a bottom that's gradually rising.
Okay, I can picture that.
The flat top is formed by connecting the highs. That's our resistance level. And the rising bottom that's formed by connecting the lows.
Support level.
Exactly. And this pattern often shows up after an uptrend has already been established.
So the market's already moving upwards, and then this triangle forms.
Right. And it's interesting what happens inside that triangle. The market's basically consolidate, taking a breather.
Okay.
That flat resistance line acts like a ceiling, a psychological barrier.
So each time the price hits it, it retreats.
Exactly. Shows there's some selling pressure at that level. But, and here's the key, those rising lows, that upward sloping bottom line, tell us that buyers are getting more aggressive.
More aggressive, meaning what?
They're willing to buy at higher and higher prices.
Okay, so they're pushing that support line higher.
Exactly. And the expectation is that eventually this buying pressure will overwhelm the sellers at that resistance level.
And boom, the price breaks out upwards.
Right, continuing that initial uptrend.
So the key moment is that breakout above the resistance line.
Right. And our source points out something important here.
What's that?
Volume confirmation.
Volume.
Yeah, the amount of trading activity. Ideally, you want to see declining volume as the triangle is forming.
So things are kind of quiet. No one's making any big moves.
Right. It's a period of indecision.
Yeah.
But then when that breakout happens above the resistance, you want to see a surge in volume.
Like a sudden burst of activity.
Exactly. That adds credibility to the breakout, shows that a lot of traders are now believing in that upward move.
That makes sense. More people jumping on board.
However, our source also makes a really good point.
What's that?
Sometimes, if the price breaks down below that rising support line, it can actually signal a downtrend.
Oh, so it can go the other way.
It can.
So these patterns aren't foolproof.
They're not crystal balls, more like educated guesses. They give us probabilities, not guarantees.
Right. The market always has a few tricks up its sleeve. Now, the descending triangle, I'm guessing that's just the opposite of the ascending one.
Pretty much. It's like flipping the ascending triangle upside down.
So instead of a flat top, it has a flat bottom.
Right. That flat bottom is your support level. And then you have a downward sloping top line, which is your resistance.
So it's forming after a downtrend.
Exactly. And the expectation is that the price will eventually break down below that flat support line, continuing the downtrend.
So those lower highs are kind of like the market testing that support level, seeing if it can hold.
Exactly. And with each test, the sellers are kind of chipping away at it.
And just like with the ascending triangle, increased volume on that breakdown would add more weight to the signal.
Exactly. But, and this is important to remember, sometimes a break above that descending resistance line could signal a shift to an uptrend.
So again, got to be prepared for different possibilities.
Always. Now, what if we ditch those flat lines, those horizontal levels, and just have two trend lines that are converging towards each other?
Okay, I'm visualizing it, like a narrowing path.
Exactly. That's the symmetrical triangle.
Symmetrical meaning it's the same on both sides.
Right. And our source points out that it can act as a continuation pattern if it forms within an already established trend.
So if we're in an uptrend and we see this symmetrical triangle forming, chances are the uptrend will continue.
Higher probability, yes. But here's the catch. If there's no clear trend beforehand, the symmetrical triangle becomes bilateral.
Meaning it could break out in either direction.
Precisely. So this one's all about being patient, waiting for that confirmed breakout.
So no jumping the gun with this pattern.
Right. Wait for the market to show its hand.
Makes sense. Now let's move on to some shorter term patterns.
Sure. Our source talks about flags.
Flags, like the kind you wave?
Well, sort of. We've got bullish flags and bearish flags.
Okay, so two different types?
They're both characterized by parallel support and resistance lines.
Parallel, meaning they're running alongside each other.
Exactly. But the direction of those lines and the expected breakout depends on whether it's a bullish or bearish flag.
Okay, so explain that.
With a bullish flag, the lines slope downwards.
Downwards. But isn't it a bullish pattern?
It is. The price action within the flag is moving against the main trend, which can seem counterintuitive. But the expected breakout is upwards in the direction of the initial trend.
Okay, so the flag's like a pause before the upward move resumes.
Exactly. And with a bearish flag, the lines slope upwards.
So again, the opposite of what you might expect.
Right. The price is making higher lows and higher highs within the flag, but the expected breakout is downwards.
So it's like a temporary upward bounce before the downtrend continues.
Precisely. Now, the source gives a really helpful analogy here.
What's that?
Think of that initial sharp price move, the one that happens before the flag forms, as the flagpole.
The flagpole.
Yeah, it shows the strength of the underlying trend.
Okay.
Then you have the flag itself, that gentler counter-trend movement. It's like the market's taking a breather.
Okay.
And then the breakout, in the direction of the flagpole, confirms that the initial trend is still in play.
So the flagpole analogy really helps to visualize it.
It does. You can see that three-part structure. Strong move, counter-trend flag, breakout.
Got it. Flags. Flagpole. Now what about wedges?
Wedges are similar to flags in that they have converging support and resistance lines.
Converging, meaning they're getting closer together.
Yeah, right. But unlike flags, where the lines are parallel, wedges have lines that are tightening towards each other.
So they look more like, I don't know, a slice of pie.
Yeah, kinda. And as the wedge gets narrower, you often see volume decreasing.
Like the market's getting ready for something.
Exactly. Now, there are two types of wedges, rising and falling.
Okay, so rising wedge, falling wedge, what's the difference?
A rising wedge, both the support and resistance lines are sloping upwards, but they're getting closer and closer together.
So it's getting tighter and tighter at the top.
Right. And typically, this precedes a bearish breakout.
Meaning the price breaks down below the support line?
Exactly. Conversely, a falling wedge, both lines are sloping downwards and converging, often leads to a bullish breakout.
So the price breaks out above the resistance line.
You got it.
So rising wedge, brace for a fall. Falling wedge, anticipate a rise.
Precisely. Our source also mentions that some traders might try to trade within the wedge.
Within the wedge?
Yeah, playing those small price swings between the support and resistance lines.
Before the eventual breakout.
Right. It's a bit riskier, but potentially more rewarding if you can time it right.
Got it. So we've covered continuation patterns. Now let's shift gears to reversal patterns.
Sure. Remember, these are the ones that suggest a change in the prevailing trend.
Right. Things are about to turn around.
Exactly. And one of the most common reversal patterns is the double top.
Double top. Okay. What does that look like?
It forms an M shape on the chart.
An M?
Yeah. It happens after an uptrend. The market makes 2 attempts to push to new highs, but fails both times.
So it's like it's hitting a ceiling it can't break through.
Right. And there's a little dip in between those 2 highs. That dip establishes a support level.
Okay.
And the signal for a bearish reversal is when the price breaks down below that support level.
So it's like the bulls have run out of steam.
Exactly. They tried twice to push higher, couldn't do it, and now the bears are taking over.
Interesting.
Now, our source stresses the importance of confirming that support level. Just because you see 2 peaks doesn't automatically mean it's a double top.
Right. We've got to be careful not to jump to conclusions.
Exactly. And often, that second peak won't even reach the height of the first.
So it's a weaker attempt.
Exactly. Another indication that the buying pressure is fading.
Okay, makes sense. And I'm guessing the double bottom is the mirror image of the double top.
You got it. Instead of an M, it forms a W shape on the chart.
Okay, a W. And it happens after a downtrend.
Right. The market makes 2 attempts to break through a support level, but fails both times.
So it's like it's bouncing off the floor.
Exactly. And there's a little bounce upwards in between those 2 lows.
Okay.
That bounce establishes a resistance level.
And the signal for a bullish reversal is when the price breaks above that resistance level.
Precisely. It's like the sellers have given up, and now the buyers are in control.
M for bearish reversal. WN for bullish reversal. Easy to remember.
It is. Now, the next reversal pattern is a bit more complex.
Okay, bring it on.
It's called the head and shoulders pattern.
Head and shoulders.
Yeah, it's a classic bearish reversal pattern that often forms after an uptrend.
Okay.
It's characterized by 3 successive highs. The middle one is the highest. That's the head. And then you have 2 lower highs on either side. Those are the shoulders.
So it looks like a head with 2 shoulders.
Precisely. And all 3 of those highs reach roughly the same level of support.
A support level that runs across the bottom of the pattern.
Exactly. We call that the neckline.
The neckline, okay.
Now, the bearish signal comes when the price breaks down below that neckline.
After that third high, the second shoulder.
Right. It's like the market's trying to rally, but just can't muster enough strength.
And each rally is weaker than the last.
Exactly.
So we've got the double top, the double bottom, and the head and shoulders. What other reversal patterns are there?
Well, our source mentions rounded tops and bottoms.
Rounded tops and bottoms, okay.
Rounded top looks like an upside-down U.
Okay.
And it signals a potential downtrend after an uptrend.
So the market's kind of gradually losing steam.
Right. And a rounded bottom looks like a regular U.
Okay.
And it suggests a potential uptrend after a downtrend.
So the market's slowly turning around.
Exactly. Our source points out that these rounded patterns tend to form over a longer period than the double tops and bottoms.
So it's a more gradual shift in sentiment.
Precisely. And finally, we have the cup and handle pattern.
Cup and handle, that's an interesting name.
It is. Our source even jokes that it sounds like something you'd have coffee in.
Yeah, it does. So what does it look like?
It's similar to a rounded bottom. That's the cup part.
Okay.
But then it has a little dip after that. That's the handle.
The handle, okay.
And that handle can sometimes resemble a small flag pattern.
Oh, interesting.
And the overall formation is considered a bullish reversal pattern, usually appearing after a downtrend.
So it's like the market takes a little pause before continuing upwards.
Exactly. Okay, so we've covered a lot of patterns.
We have.
But how do traders actually use this information?
Yeah, that's the big question.
Well, the general idea is to try to profit from the breakout that happens after the pattern forms.
So if you see a bullish pattern forming, you might buy in anticipation of that upward breakout.
Exactly. And if you see a bearish pattern, you might sell in anticipation of a downward breakout.
Okay, makes sense. But we've got to remember these patterns aren't foolproof, right?
Absolutely. Our source emphasizes that these are educated guesses, not guarantees.
So how do traders avoid getting caught on the wrong side of a trade?
Confirmation is key. The simplest form of confirmation is to wait for a session or two after a potential breakout.
A session.
Yeah, like a trading day, just to see if the price action holds.
So if the price keeps moving in the expected direction after the breakout, that adds more confidence.
Precisely. And traders also use other technical tools for confirmation.
Like what?
Moving averages, momentum indicators, things like that.
And volume, right. We talked about that earlier.
Exactly. High volume on the breakout adds more weight to the signal.
Got it. So confirmation is crucial. What about risk management?
That's equally important. Our source talks about stop-loss orders.
Stop-loss orders, what are those?
It's basically an instruction you give your broker to close your position if the price moves against you by a certain amount.
So it's like a safety net.
Exactly. It limits your losses if the trade doesn't go your way.
Makes sense. How do you determine where to set your stop loss?
Well, our source provides some general guidelines. For bearish patterns, you might set it just above the highest point of the pattern.
So if the price breaks above that, it might mean your bearish outlook was wrong.
Right. And for bullish patterns, you typically set it below the lowest point of the pattern.
Okay.
The source gives an example with the bull flag, suggesting a stop loss just below the flag's support line.
Got it. And finally, what about profit targets?
Ah, yes. Traders often try to estimate how far the price might move after the breakout
How do they do that?
by looking at the height of the pattern.
Yeah.
For example, if the distance between the support and resistance lines of a bull flag was 50 points, a trader might set a profit target 50 points above the breakout point.
Okay, so they're using the size of the pattern to gauge the potential size of the move.
Exactly. And that brings us to the concept of the risk-reward ratio.
Risk-reward ratio.
It's basically comparing how much you're risking on the trade to how much you're potentially gaining.
Okay.
So in that bull flag example, if you have a 50-point profit target and a 25-point stop loss, your risk-reward ratio is 1.2.
Meaning you're risking 1 unit to potentially gain 2.
Precisely. Traders generally look for risk-reward ratios of at least 1.2 and preferably higher.
So the potential reward should outweigh the risk.
Exactly. So to wrap things up, these 11 chart patterns from forex.com US can be really valuable tools for understanding market movements.
They're based on the idea that history often repeats itself, or at least rhymes in the markets.
Right. But we've got to remember that these patterns aren't guarantees.
They're educated guesses, and confirmation and risk management are crucial.
Absolutely. We hope this deep dive has given you a solid foundation in trading chart patterns.
A shortcut to becoming more informed and confident in your understanding of the markets.
Now it's your turn to put this knowledge into practice.
Yeah, go out there and look at some real-world charts.
Try to spot the patterns we've discussed. The ascending triangles, the double bottoms, the head and shoulders.
Seeing them in action can really solidify your understanding.
Yeah, and here's something to think about. As you're looking at those charts, consider the human element.
The human element.
Yeah, think about how the emotions and decisions of countless traders contribute to the formation of these patterns.
Interesting.
What might the story behind each pattern be? What's driving those shifts in buying and selling pressure?
That's a fascinating question to ponder. Thanks for joining us on the deep dive. We'll see you next time.
Until then, happy charting.